Well, Kelly, I don't want to pull out my pin and poke it here, but the optimism certainly is interesting to see that after earnings, we'll find out if they really did lose some ad revenue to Meta. So Meta's done a great job of stealing that ad revenue. So I look here near its 52-week high. This is a $29 level at the 52-week high. I want to see it pull back. So I want to be a seller here, Kelly. 22.50, that's the 200-day moving average.
All right. Well, very clear, crisp. We'll leave it right there. We'll move along to BP. The European, they were beyond petroleum. Maybe now they're turning the clock back. Anyway, they're reporting overnight at a time when global oil prices are hovering near 52-week lows. This is what's so interesting. 52-week lows for oil prices, while equities remain near 52-week highs. We turn to Pippa Stevens for more on this one. Pippa, what do you think?
The first thing I think, of course, Kelly, is the shareholder return program. If there's been a theme of energy earnings so far, it's that these companies are making a lot of money. But we have seen a slight divergence in what they're choosing to do with that cash. We saw companies like Chevron and Shell increase their buyback programs, while Exxon notably did not, and maybe investors had thought that they would. And so what direction is BP going to go in? And then, of course, the company's outlook on oil and gas prices. Now, it does have a pretty robust refining and marketing division, meaning it's not quite as levered to commodity prices as some of its peers. But just last week, BP said that they actually think that the peak of oil and gas demand is going to come sooner than previously expected, thanks to Russia's invasion of Ukraine, and that will hasten the transition away to renewables. So with that longer-term forecast, how are they thinking about the short and near-term production policies? And then finally, how are they thinking about their renewable energy investments? BP, along with its European majors, have really accelerated those investments more so than their American counterparts. But just last week, the Wall Street Journal reported that CEO Bernard Looney is actually questioning some of those investments. Right. They cited those familiar with the conversations, saying that maybe they'll dial back some of that spending for renewables. So how do they think about that within the context of declining oil and gas demand?
Yeah, and their PE, what I just see, was about 5.5 times. So, Jeff, what would you do with the stock here? I mean, I think people have been really surprised how weak oil prices are behaving, and that's got to have energy investors a little concerned.
It does, Kelly, but I'm not going to walk away from the energy sector. Energy sector has been a theme that was a 2022 favorite. It's going to persist in 2023. What's fascinating about BP, it's the little brother to Chevron and Exxon. And as the youngest of three boys, I am the little brother. But look at the market cap here. $103 billion in comparison to $450 billion in ExxonMobil. So I know we have some insider buying, which has promoted some enthusiasm. But of course, we saw some insider buying in Tesla, and that drove Tesla lower. So maybe there's an opposite effect here. But I want to be a buyer lower.
Yeah,
and I'm going to lean on the technicals.
And I know, like you're saying, Jeff, you don't want to throw in the towel yet on the energy trade, and I get that. But it does seem like we've gone from having gluts to having shortages to almost having gluts. We see it in nat gas. Look at the inventory build numbers we've been getting, even on the oil side, and the price of crude, even after Friday's jobs report. I mean, if it's not trading well after all of that, then doesn't that tell you something's wrong?
It does and it doesn't. You have to look through the perspective that this has dragged so long to Chevron and Exxon. Maybe there's a mean reversion opportunity here because if you look at a 1 year, 3 year, 5 year, it's dragged both of those names. So I think that's the prism, the perspective I want to look at here, but I want to buy it lower. Look at $32.
All right, fair enough. Pippa, thank you. We turn to cruise giant Royal Caribbean now, expected to report a loss tomorrow morning, but the shares are still up 40% this year, and occupancy rates are expected to be near 95%. Let's turn to Seema Modi for more of the story here. Seema.
Kelly, what a start to the year. Royal Caribbean, Carnival, and Norwegian Cruise Line on pace for their best start to the year on record. As you pointed out, up 40%, now trading at 11 times earnings. That's above pre-pandemic levels on this expectation that this is the year that cruising will come back. However, a new channel check survey from Morgan Stanley suggests that they're seeing some pricing softness in the month of January. So I think that's why this earnings report will provide a very crucial read on what exactly Royal Caribbean is seeing, not just over the last 3 months, but going into 2023. Can they achieve that level of profitability that they set out for in September of last year? And then the question on China. It was fall of last year when CEO Jason Liberty told us that they are leaving China because of the ongoing lockdowns, concerns around when they could actually get back to sea. Well, here we are with the story of a China reopening. When are the cruise lines expected to re-enter that market? Of course, that's played a role in the outperformance of cruise stocks so far this year.
Great point. If they mention China or AI, they're sure to see a rally on that earnings report. Jeff, do you like the stock here?
You know, if you want exposure in this space, yes, I want to be a buyer here. So if you look at This is the second largest cruise company, obviously secondary to Carnival. So if you look at the two in a comparison, the big focus is the net losses. They were profitable in Q3 of 2022, and now they're back to a $355 million expected loss. If you match that up, Kelly, with the service of debt, they have a debt service of $352 million because their balance sheet debt has swollen nearly $23 billion. So if you want to have exposure to space, I think there's an opportunity to move higher because revenue has nearly gone up 200% to $2.6 billion. So I do like it here. Be cautious. Again, this is a small beta, low $17 billion market cap. So there's going to be higher beta with this low of a market cap.